Yeah, hello friends. This is CS Sai Akash. So let us continue with CA Intermediate Financial Management Revision series, and today's chapter is capital structure. So one prerequisite before we start capital structure is that you should be completing cost of capital chapter completely. So if you have not seen cost of capital chapter revision series, please go complete that chapter first and then come here. Yes. So capital structure, again a very important chapter from exam point of view. What are we going to study? We'll study theories. Apart from theories, again there are certain set of concepts and there are full-fledged questions. So let us start with capital structure theories. So broadly, if I want to classify capital structure chapter, I can classify into two. One is capital structure relevance theory, capital structure irrelevance theory. So what do you mean by capital structure relevance theory? Capital structure relevance theory means whatever is my debt equity mix in my capital structure. So the proportion of debt and the proportion of equity in my capital structure, that will have an impact on my WACC. In other words, my WACC is dependent on my debt equity mix. So that is called capital structure relevance theory. So what do you mean by capital structure irrelevance theory? Sir, irrespective of your debt equity mix, you may be having 20% equity, 30% equity, 70% equity, or 100% equity. So irrespective of your debt equity mix, your WACC will remain constant. So what do you mean by capital structure relevance theory? WACC is dependent on my debt equity mix. What do you mean by capital structure irrelevance theory? My WACC is not dependent on my debt equity mix. Correct? So WACC changes with every change in capital structure in case of relevance theory. And here, in case of capital structure irrelevance theory, WACC will remain constant. What are the approaches that we need to study in capital structure relevance theory? Again, there are two approaches here, two approaches there. In capital structure relevance theory, there is something called net income approach and traditional approach. And coming to capital structure irrelevance theory, again, there are two approaches, net operating income approach and M&M approach. If you see the third one, M&M without tax, M&M is there in capital structure relevance also, capital structure irrelevance also. Earlier in 1958, he came up with the first approach, which was the capital structure irrelevance theory. Again, after facing criticism, he modified his approach in 1963. Then we have M&M with tax approach. Yes. So in total 4 plus 1, 5 we need to study. We'll start with the general assumptions. For all the theories that we'll study that we have seen above, for all theories, these are the standard general assumptions. So this is applicable for all theories, for all the 5 theories. What are these general assumptions? In total, there are 7. You need to remember the count. So this theory assumes there are only two sources of finance, that is equity and debt. So equity and debt means here I mean equity share capital, not your equity. So there are only two sources of finance. One is equity share capital, another one is debt. In other words, there is no preference share capital, there is no retained earnings. And the total assets of the firm are given. The total assets of the firm are given. Whenever I raise money in the form of debt, what will I do with that money? I redeem equity. And whenever I raise money in the form of equity, what will I do? I'll repay debt. Understood? When I raise equity, I'll redeem debt. When I raise debt, I'll redeem equity. Yes. The total assets and the total capital requirement of the firm is given and it is constant. Very important unrealistic assumption. There are no taxes, but in real world, there are taxes. Next assumption is 100% payout ratio. When I say 100% payout ratio, it means no retention, no retained earnings. That correlates with the first assumption that there are only two sources of finance. One is equity, other one is debt. So there is no retained earnings because 100% of the profits are paid away as payouts, dividends. And the total financing remains constant. The total financing remains constant. It is in correlation to the second point. And the business risk is constant. What is the assumption? The business risk is constant and the firm has perpetual life. So these are all the assumptions applicable for all the 5 theories. So in total, there are 7 assumptions. There are only two sources of finance, equity share capital and debt. There is no preference share capital. There is no retained earnings. And the total assets of the firm are given and they are constant. Whenever I raise money in the form of debt, I'll repay equity. Whenever I raise money in the form of equity, I'll repay debt. And there are no taxes, 100% payout ratio. It means no retained earnings. Everything, all the profits are paid away as dividends. And the total financing requirement of the firm is constant. Business risk is constant and the firm has perpetual life. So these are the general assumptions which you need to remember for all the subsequent series that we are studying now. Yes. Now we'll start with first approach, net income approach. It is also called Durant's approach, net income approach or Durant's approach. So in addition to the 7 general assumptions that we have 3 additional assumptions. So what are the additional assumptions made by Durant? First one, KD means debt capitalization rate, KE means equity capitalization rate. He has defined it. KD is always less than KE. KD is always less than KE. We know KD is always less than KE because it comes with a tax shield impact that we have stated in revision of the basics, FM basics. But here the assumption says there are no taxes. But here KD is always less than KE. Again, assumptions means what? It is unrealistic. That is why it is called assumption. We have to accept as it is. Very, very important. Constant KD, constant KE. So this theory assumes your cost of debt as well as cost of equity will remain constant. KD is also constant, KE is also constant. So these are the additional assumptions made by Durant, net income approach. What does the theory say? So these were the assumptions. So what is the theory? The theory says debt is cheaper than equity. For every increase in the proportion of debt in my capital structure, my WACC will come down. Correct? So debt is a cheaper source of finance. Whenever I increase the proportion of debt in my capital structure, my WACC will come down. Yes. And how do we determine value of the firm as per this approach? The formula is EBIT divided by WACC. The formula is EBIT divided by WACC. Since I'm capitalizing the value of the firm using WACC, when will the value of the firm be maximum? When WACC will be minimum. When will WACC be minimum? When there is maximum debt. Understood? What is the theory trying to say? Debt is a cheaper source of finance. Increasing the proportion of debt in the capital structure will cause a reduction in WACC. Whenever there is maximum debt, WACC will be minimum. How is value of the firm determined? Using the formula EBIT divided by WACC. So whenever WACC is minimum, value of the firm will be maximum. So this is the theory given by net income approach. Understood? So next, how do you solve questions? From application point of view, from exam point of view, how will you solve the questions? So stepwise, you need to remember all these theories are stepwise. You need to remember. What is step number 1? Determine EBIT. You know how to do that. The entire profitability statement. Then EBIT minus interest EBIT. Step number 1 EBIT. Step number 2 EBIT minus EBIT. EBIT minus interest equal to EBIT. What is step 3? This is very, very important step. Sequence matters. Sequence matters. So first here you need to find out what value of equity. Value of equity. So how do you calculate value of equity? EBIT divided by K. K is nothing but cost of equity. Step 4, you need to determine value of debt. How do you determine value of debt? Interest divided by KD. Step 3, value of equity. Step 4, value of debt. Interest divided by KD. Next, step number 5, value of firm. How will you get value of firm? Step 2 minus plus step 3. Sorry, step 3 plus step 4. That is value of equity plus value of debt. Then last step, you will calculate WACC. How do you calculate WACC? EBIT divided by value of the firm. EBIT divided by value of the firm. The sequence in which you solve the questions matter for each of the theories. So for net income approach, which is a capital structure relevance theory. When I say capital structure relevance theory, whenever I change my debt equity mix, my WACC will change and also the value of the firm will also change. Correct? So how do you solve? From exam point of view, step 1, step 2, step 3. Step 1 EBIT, step 2 EBIT minus interest EBIT. What is step 3? You need to calculate value of equity. How do you calculate value of equity? The formula is EBT divided by KE, that is cost of equity. Next, you need to find out value of debt. How do you find out value of debt? Interest divided by KD. Next step is value of the firm, that is value of equity plus value of debt. Last step is calculation of WACC, EBIT divided by value of the firm. Yes, so this is how we will solve exam questions. Next, we'll go ahead with net operating income approach. Net operating income approach is a capital structure irrelevance theory. It is a capital structure irrelevance theory. In addition to the general assumptions, the 7 assumptions that we studied, in addition to that, there are again additional assumptions. What are the additional assumptions? KD is always less than KE. Again, similar in the previous approach also KD was always less than KE. Constant KD, again previously also we said constant KD. Now what is the difference? In the previous approach he was assuming KD is also constant, KE is also constant for all levels of debt equity mix. But in this approach he is saying KD will remain constant but KE will increase, increasing KE, and your WACC will be constant, constant WACC. So what are the additional assumptions? KD is less than KE, constant KD, increasing KE, constant WACC. So what does the theory say? The theory says debt is a cheaper source of finance, correct? But whenever I increase the proportion of debt in my capital structure, risk will increase. Ultimately, who takes the responsibility of that risk? The equity shareholders, correct? So as and when I increase the proportion of debt in my capital structure, it causes the risk also to increase. Whenever there is an increase in risk, the equity shareholders expectation will also increase, correct? In other words, KE will also start increasing. So in the earlier approach, what we said, debt is a cheaper source of finance. Increasing the proportion of debt will cause a reduction in WACC. But in NOI approach, the approach says that when you try to do is debt is a cheaper source of finance, increasing the proportion of debt in your capital structure will cause the WACC to come down. You will not be able to do this because for every increase in debt, what will increase? Risk will increase. Who will take that risk? Equity shareholders. When he is taking more risk, he expects more returns. So my KE, instead of coming down or instead of being constant, my KE will also start rising. In other words, I was trying to achieve a benefit that I'll increase the proportion of debt so that WACC will come down. I'll not be able to do that because for every increase in debt, my risk will increase, and the WACC, instead of coming down, it will remain constant. So this is the theory. Yes, for every increase in debt, there is an increase in risk. Increasing risk means increase in KE. So for every increase in debt, KE will also increase. Thus overall WACC will remain constant. So the market will not value you individually. What is the value of equity, value of debt? No, the market will see your company as a whole without assigning individual values to your debt equity mix. So how is the value of firm determined here? Here it is capitalized by EBIT divided by KO, and KO remains constant. So what is an optimum capital structure as per this approach? There is no optimum capital structure because it is a capital structure irrelevance theory. All capital structures are optimum capital structures. If you ask me what was an optimum capital structure as per NI approach, what was the optimum capital structure as per NI approach? Where there is maximum debt. So always you should put maximum permissible debt where in NI approach. But if you come to NOI approach, which is an optimum capital structure, where every capital structure is an optimum capital structure because the WACC and value of the firm will remain constant. Yes, this was about the theory. Sir, how do we solve exam questions? Again, stepwise approach, step 1, step 2, step 3. First step will remain same, EBIT minus, first step is EBIT, second step EBIT minus interest EBT. Again, no complication. Coming to step 3, again sequence matters. Here in the step 3 itself, I am calculating what? I am calculating value of the firm. Earlier I was calculating value of equity first. First I used to calculate value of equity, then value of debt, then value of equity plus value of debt will give me value of firm. But here what am I calculating first? I am calculating value of the firm first. So how do I calculate value of the firm? EBIT divided by KO. Next step, I need to calculate value of debt. How do I calculate value of debt? Interest divided by K, no change. Then how do I calculate value of equity? The fifth step is value of equity. How do I calculate value of equity? It is value of the firm minus value of debt. So how will I get value of equity? It is value of the firm minus value of debt. And the last step, I'll calculate KE. In the last step, I'll calculate KE using the formula EBT divided by value of equity. EBT divided by value of equity. Understood? Sequence matters a lot. How do you differentiate and remember individual theories? By remembering in a stepwise manner, and sequence matters. Again, step 1, step 2, EBIT. Step 2 is EBIT minus interest EBT. Till here, no confusion. Here, first we will calculate value of the firm. Step 3 is value of the firm. How do I calculate? EBIT divided by KO. EBIT divided by KO. Next, I will find out value of debt. How will I calculate value of debt? Interest divided by KE. Next, I will calculate value of equity. How will I calculate value of equity? Value of firm minus value of debt. Last step is value of equity. How do I calculate value of equity? EBT divided by value of equity. EBT divided by value of equity. So that completes net operating income approach, which is the capital structure irrelevance theory. Coming to very practical approach, that is traditional theory. Again, what are the additional assumptions? These are in addition to the general assumptions. KD is less than KE. Here they are saying increasing KD, increasing KE. The first approach said everything is constant. KD is also constant, KE is also constant. The second approach said KD is constant, KE is increasing. Here this approach says KD is also changing, KE is also changing. In other words, increasing KD, increasing KE. And what is important, the increase in KE is more steeper than increase in KD. In other words, the increase in KE is much more faster than increase in KD. Again, what does the theory say? The theory says debt is cheaper than finance. For every additional debt, my WACC could have come down. This is what you are trying to achieve. But what happens is that when for every increase in debt, my risk will also go up. But not just the equity shareholders will take that risk. The second person, the marginal cost of capital, the second debt provider, whenever he is taking additional risk, his KD will also increase. So what does this theory say? This theory says debt is a cheaper source of finance. Employing the higher amount of debt in your capital structure to a certain extent will cause a reduction in WACC. Yes, but however, if you start raising debt beyond this point, so this point is called an optimum point. Beyond this optimum point, if you also start raising debt in that point of view, my KD will also start rising, my KE also will start rising, and my WACC, instead of coming down, it will go up. Understood? Again, I'll repeat. So what does the traditional theory says? Debt is a cheaper source of finance. Increasing the proportion of debt in the capital structure will cause a reduction in WACC. Till here it is fine. But if the debt proportion goes beyond a point, beyond the optimum point, in that case my KD will also start rising, my KE will also start rising, and my WACC, instead of coming down, it will go up. So till that point, when you raise debt, till a certain optimum point, when you raise debt, it is okay. KD will also be constant, KE also will be constant. But if you increase the debt beyond a point, KD will also start rising, KE will also start rising, WACC instead of coming down, it will go up. Hope this is clear. So which is a good optimum capital structure here? You need to calculate WACC for various debt equity mix, and wherever there is lowest WACC, you need to choose that point. Hope this is clear. Yeah. Yes. Now we'll go to very important approach, that is M&M. Mark this as very important from exam point of view. Very important. Yes. So M&M is a bit exception. Normally what people say, M&M says the other way around. Okay, his thinking is totally different. Yes, Modigliani and Miller approach. It is an extended version of NOI. It is an extended version of which approach? NOI. Correct. It was 1958 without tax approach. The one which we are studying right now is an extended version of NOI given by M&M, Modigliani and Miller in 1958, and which is a without tax approach. Apart from the general assumption, what are the additional assumptions made by M&M? First is KD is less than KE. Fair enough, everybody is making this assumption. He's also making it. Constant KD, increasing KE. Again, this is the extended version of NOI. So same assumptions of NOI are repeated. Constant WACC. Now these were, see, till here whatever we saw, these are just what? These are just nothing but NOIs. Correct? These are just nothing but NOIs assumptions. And from here till here, these are pure M&M assumptions. Yes. What are these assumptions then? Here M&M is assuming perfect markets. M&M says the markets are perfect. You know what is perfect market? There are no imperfections. You have studied in economics. And investors are free to buy all securities. So there is no restriction. I can go and buy the securities, all the securities. Yes. Investor is aware about risk and return of all type of securities. As an investor, I have up-to-date information. I know all the risk and returns of all the securities in the market. This is the assumption made. Next assumption, there are no transaction cost. M&M believes that whenever I buy a security or I sell a security, there is no transaction cost. And he believes that all are rational investors. M&M believes that all investors are rational and they can borrow without any restrictions on the same terms as the firms do. Again, this is very important unrealistic assumption. So what does this assumption say? Suppose if I'm a shareholder of Reliance Industries Limited, on what terms, on what interest rate Reliance Industries can borrow money from the market? M&M is saying that as a shareholder, as an investor, I can also go and buy money. I mean, I can take loan on the same rate of interest as it was given to Reliance Industries. So individuals, investors can borrow without any restrictions on the same terms as the firms do. So this is one of the very important assumptions made by M&M, which is totally impractical. Yes. And again, he classifies homogeneous risk class of firms. So he believes that if for all the automobile industries, he classifies as a homogeneous group. For all the pharmaceutical companies, he classifies as a homogeneous risk class, which is again not practical. And again, he assumes that there are no corporate taxes. Yes, very important unrealistic assumptions, but from exam point of view, they are very important. Yes. What are the assumptions made? KD is less than KE, constant KD, increasing KE, constant WCC. These are just copy paste of NOI. Next, what are the additional assumptions made by pure additional assumptions made by M&M? The markets are perfect. Investors are free to buy all securities. Investor is aware about all risk and return of all types of securities. There are no transaction costs. There are rational investors. They can borrow without any restrictions on the same terms as the firms do, and homogeneous risk class of firms. And there are no corporate taxes. So these are the additional assumptions made. So what does the theory say? M&M theory says it is an extended version of what? NOI. So debt is a cheaper source of finance. Increasing the proportion of debt will change what? The risk perception of equity shareholders. See, basically debt means risk. So increasing the proportion of debt means risk is getting increased. Who ultimately takes risk in any company? The equity shareholders. So whenever I increase my debt, whose BP sugar will come up? Equity shareholders BP sugar will come up. Yes. So for every increase in debt, there is increase in KE. Therefore, WACC will remain constant. It is an extended version of NOI. Yes. Now, market capitalizes the value of the firm as a whole without assigning individual value to debt equity mix. Every capital structure is an optimum capital structure. So more or less it is extended version of NOI, but he gives some behavioral justification. How do you solve exam questions? Very, 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 very important. Please pay attention. So how do you solve M&M exam questions? There are two cases. Whenever as an investor I'm moving from a levered company to unlevered company. Levered company means the company which had debt. Unlevered company means the company which do not have any debt. So when I'm moving from a lever, I was a shareholder in a levered company. Now I am becoming a shareholder of an unlevered company. What will I do? Step 1, step 2, step 3. You need to remember stepwise. So how do we solve exam question? So investor will first sell his stake in the levered company. Currently, I'm a shareholder of which company? I'm a shareholder of a levered company. I will sell those shares. Suppose I'm a 10% shareholder means I'll sell 10% shares in the levered company. Step 2, very, very, very important is step 2. The investor will borrow. The investor will borrow on the same terms as the company did. I'll tell you, understand. We'll take some time here, even though this is a revision class. I was in a levered company. Levered company means the company had debt. Whenever the company had debt and I am an equity shareholder, say I own 10% of the company, then in that total debt, 10% was sitting on my head. Correct? Now I'm going to unlevered company which does not have any debt. Now I'm a person who used to have debt on my head. But in the new company, there is no debt. But without debt, I cannot sleep. Yes, so what I will do, I will borrow money in my personal capacity. I will borrow money in my personal capacity, sir. But at what terms, what interest rate? Exactly as my company had. Suppose my levered company was borrowing money at 10% interest rate. As an individual investor, again, I will also borrow money at 10% interest rate only. Sir, how much in the levered company, if say, for example, total debt was 10 crores and my portion is 1 crore. Again, I will do individual borrowing of 1 crore. Yes. So that is step number 2. The investor will borrow on the same terms as the company did. Now, step 3. What is step 3? I sold my existing shares in the levered company plus I borrowed some money. So what is the total money available for investment? Step 1 plus step 2. I had shares. I sold those shares. I got some money in my pocket. Plus I borrowed some money as the same terms as the company did. So some borrowing, that loan money is also sitting in my pocket. So what is the total money available for investment? Step 1 plus step 2. Now coming to step number 4. What will I do with this money? With this money, I'll become an investor of the unlevered company. With this money, I'll become an investor of a unlevered company. Sir, how many shares will you buy? Exactly the same shares. Here, if I was a 10% shareholder, I'll buy 10% shares. So I'll become a shareholder in unlevered company. What will happen when I do this? When I do this, I'll have an arbitrage gain. I'll have an arbitrage gain. Say, for example, step 3, you got 20,000, and when I invest in an unlevered company, the price will be say 15,000. That 5,000 is my arbitrage gain. When I shift from a levered company to unlevered company, I'm making a profit of 5,000. So this is called M&M without tax, moving from a levered company to unlevered company. Step 1, step 2, step 3. Very, very important is step number 2, whether the investor will borrow or he will lend. So when I'm moving from a levered company to unlevered company, I borrow. I borrow. Why? Because I was used to having loan on my head. In the new company, there is no loan. In the company, there is no loan means I'll have loan in my personal capacity. Simple. Remember from this perspective. Yes, step 1, step 2, step 3, step 4. Very, very important. Hope this is clear. Now, coming to a unlevered company to levered company. Again, M&M without tax, 1958 approach, moving from unlevered company to levered company. Again, step 1 will remain same. I will sell the shares now in the unlevered company. Currently, my shareholding is in which company? It is in unlevered company. Step number 1, I will sell those shares. Step number 2, what will I do? I will lend to the new company. I will lend money to the new company. I am moving from unlevered company to levered company. Unlevered company means company which did not have any debt. I am that person who don't want any debt when I sleep. I want to go and sleep peacefully. But now I'm becoming the owner of a levered company. Company has debt, and if I become a 10% shareholder, equity shareholder, 10% of the total debt will be on my head. I don't want that. So what will I do? I will say to the company, boss, you don't borrow money from somebody else. I will only give you 10%. Understood? I will lend money to the company. I will lend money to the levered company. Lend money means what? It means as good as buying debentures. Correct? So I was in a unlevered company. I don't want any loan on my head. If I go to a levered company, then the company will have debt. That portion will come on my head. I don't want that. So what I will go and tell the company, boss, I will buy your own debentures. You don't take money from somebody else. I will only give you money. Understood? Step number 1 is same. I will sell the existing shareholding. Step number 2, there is a difference. When I was moving from a levered company to unlevered company, I was borrowing money. I was borrowing money. Here I am lending money to the company. I am lending money to the company. How will you remember? Remember whether what you had on your top of your head. In a levered company you had loan, in the new company no loan, you borrow. In an unlevered company no loan, but in the levered company wherever you are going there is loan. You don't want any loan, then you lend to the company. This is how you remember. Coming to step number 3. Now what is the money left for investment? Whatever money I had sold by, whatever money I had got by selling those shares, some money I bought debentures. I lend some money to the company. Now I have money left for investment. Step 1 minus step 2. Now I will become an investor in a levered company, and again by this I will achieve arbitrage gain. Yes. Again, say for example, total money available for investment was 12,000, and when to become a investor in the levered company I spent 10,000. Then 2,000 is my arbitrage gain. Correct? By shifting from a levered company to unlevered company, or from unlevered company to levered company, as per M&M, subject to all the assumptions, unrealistic assumptions made by M&M, I'll achieve arbitrage gain. Understood? Yes. But important note, very very important note, again exam question will end here only till you calculate arbitrage gain, but the question will ask you to calculate the ultimate earnings, the net earnings as an investor. In that case, when I move from a levered to unlevered or unlevered to levered, as a shareholder, when I drop as an investor, I drop my profitability statement, then in both the cases my net earnings will remain same. This we have discussed in the classroom as well. What should I do? I need to calculate EBIT minus interest, whatever is the net earning, the profitability statement as an investor. So in step number 1, what happens? I had borrowed some money. Whenever I borrow some money, I have to pay interest, and whenever I lend some money, I'll get interest. Correct? I'll get interest. So that adjustment if you do, and if you compare, whenever in the old company and new company, your net earnings, the earnings that is available for you as an equity shareholder will remain same only. Again, this is to be only shown if asked, specifically asked in the exam. Otherwise your exam question will end at which stage? At arbitrage gain stage. Again, what variety of questions can be asked? Rather than investing the full amount that is available for investment, I can do partial reinvestment. So full reinvestment, partial reinvestment. These are again a few variety of questions given in the ICAI module. Yes. Now all this has happened. People went, they did criticism of M&M boss. What are your assumptions? Who will be so calculative? I'm 10% holder here. I'll be only 10% here. I will borrow on 6% only, as the company also had borrowed at 6%. Everything in real life will not at all be possible. There are no transaction costs in doing this entire process. There is, in real life, STT goes away, there are taxes, there are processing fees, there are DP charges, there are a number of charges. Then he faced criticism. So people criticize him for unrealistic assumptions. The markets are not perfect. There are imperfections. There are transaction costs in real life, and the interest rates are not same for individuals and firms. Investors will never behave in such a rational manner. Investors will not have free and up-to-date information, and taxes exist in real world. So all these, whatever were the assumptions made by M&M, now they became his criticisms. So whatever were the unrealistic assumptions, now they have turned out to be his criticisms. After facing all of this, M&M became Shana. Then he came up with one more approach in 1963. Remember first approach in 1958. Now second approach is M&M with tax, which is a capital structure relevance theory. Earlier M&M was capital structure irrelevance theory. Now M&M totally took a U-turn, and now he became a capital structure irrelevance theory. That is called M&M with tax. Very very important. Very important. Now what is the version? This version is nothing but an extended version of which approach? NI. M&M without tax was an extended version of NOI. This is an extended version of what? NI approach. What does the theory say? The theory says the value of levered firm will always be higher than value of unlevered firm. The value of levered firm, the firm which has debt, will always be more valuable than the firm which does not have debt. Why? Because of tax shield impact. You know what is tax shield impact? You don't know? Watch my first revision lecture. Yes? Now what is the application? Application is value of levered firm. How do you calculate value of levered firm? Value of levered firm is value of unlevered firm plus amount of debt into tax rate. Asset value of levered firm will always be higher than value of unlevered firm. What is the formula to calculate value of levered firm? Value of levered firm is value of unlevered firm plus amount of debt into tax rate. Now how do you calculate? Exam perspective, step 1, step 2, step 3. First you need to calculate value of unlevered firm. First you need to calculate value of unlevered firm. How do you calculate value of unlevered firm? Remember, for unlevered firm, KO equal to KE. What did I say? For unlevered firm, KO equal to KE. Why? For unlevered firm, there is no debt. If there is no debt, means there is only equity, because there are only two sources of finance. If there is only equity, there is only KE, no KD. So if there is no KD, KE is always equal to KO. Yes, for unlevered firm, KO equal to KE. Why? Because there is no debt, only one source of finance, one cost. That cost itself is KE, that cost itself is called KO. So for unlevered firm, KO equal to always KE. Now, how do you calculate value of equity? Very, very important. How do you calculate value of equity? PAT divided by K. Step number 2, we need to find out value of equity. What is the formula? PAT divided by K. PAT divided by K. This is the only approach out of all the 5 theories that we studied so far wherein I am using PAT. Otherwise, to calculate EBT, to calculate value of equity, I was always using EBT, if you remember. But since it is a M&M with tax approach, I am using PAT. Very, very important. Value of equity here I calculate using PAT. Sir, how do I calculate PAT? Simple. PAT equal to EBIT into 1 minus tax rate. How do I calculate PAT here? EBIT into 1 minus tax rate. Next, value of debt. Value of debt for unlevered firm, debt will be 0. Value of debt will be 0. Then how do I calculate value of the firm? Value of equity plus value of debt. Debt is 0. In other words, value of firm equal to value of equity. How KO equal to KE for unlevered firm. Then for unlevered firm, value of firm equal to value of equity. So this is how you solve. First, you need to calculate value of unlevered firm. Step 1, for unlevered firm, KO equal to KE. Step 2, value of equity. How do you calculate PAT divided by K? How do you calculate PAT, sir? EBIT into 1 minus tax rate. Next, value of debt. Value of debt means for unlevered firm, it will always be 0. Then value of the firm. Value of firm is nothing but value of equity plus value of debt. Debt is 0. In other words, value of firm equal to value of equity. So this was first part of the question. Second part, value of levered firm. Value of levered firm. How do you calculate value of levered firm? Step number 1. Value of levered firm is value of unlevered firm, which you have got from your this earlier workings. Value of levered firm plus amount of debt into tax rate plus amount of debt into tax rate. Next, you need to find out value of debt. Value of debt will generally be given in the question. Otherwise, interest divided by KD. But here it is post-tax KD. Remember. For all other theories, KD means pre-tax because we had assumed that there are no taxes. But M&M with tax approach assumes that there are taxes. So KD is post-tax KD here. Then value of equity. How do you calculate value of equity? Simple. Value of firm minus value of debt. How do you calculate value of equity here? Value of firm minus value of debt. Then cost of debt. How do you calculate KD? Interest into 1 minus tax rate. How do you calculate KD? Post-tax KD. This is interest into 1 minus tax rate. Now, cost of equity. How do you calculate cost of equity? PAT divided by value of equity. PAT divided by, yes means value of equity. Step number 3. So how do you calculate cost of equity? K equal to PAT divided by value of equity. How do you get PAT, sir? Here, PAT is EBIT in minus interest into 1 minus tax rate. Why earlier I had taken only EBIT into 1 minus tax rate? Here I am taking EBIT minus interest into 1 minus tax rate because earlier it was unlevered company. There was no interest, no tax rate impact. Here it is a levered company. I am paying interest. I am enjoying tax benefit on that. Understood? So how do I calculate PAT here? EBIT minus interest into 1 minus tax rate. Now last step, step number 6, I will calculate WCC. How do you calculate WCC? Same, proportion into cost, proportion into cost. Exactly what we had studied in cost of capital chapter. So there are only two sources of finance. One is debt, one is equity. That is KD into amount of debt, KE into amount of equity. So proportion into cost, proportion into cost. Only two, because there are only two sources of finance, equity and debt. So this is how I calculate WCC. Understood? M&M with tax, M&M without tax. And in M&M without tax, value of unlevered firm, M&M without tax, value of levered firm. Exam perspective, extremely important. Yes. So that completes all the 5 capital structure theories. Now we'll move to the next part of the chapter, financial BP. So what do you mean by financial BP? BP means no profit, no loss situation. You are aware. So what do you mean by financial BP? So financial BP is that level of EBIT at which my EPS is 0. I repeat, what do you mean by financial BP? Financial BP is that level of EBIT at which EPS is 0. Financial BP is that level of EBIT at which EPS is 0. In other words, when I drop a profitability statement, my EPS should be 0. Which EBIT will help me achieve that? That is called financial BP. Now, if you see at financial BP, EPS is 0. If my EBIT is less than financial BP, important from MCQ point of view. If my EBIT is less than financial BP, EPS is negative. If my EBIT is more than financial BP, if my EBIT is more than financial BP, EPS would be positive. So what is the formula? How do you calculate financial BP? Extremely simple. Financial BP formula, interest plus gross up preference dividend. Interest plus gross up preference dividend. So how do you gross up preference divided by 1 minus tax rate? preference dividend divided by 1 minus tax rate. Again, if you don't know why we are doing this, please refer first chapter revision lecture. Yes, this was all about financial BP. Again, very important, very simple. Financial BP means interest plus gross up preference dividend. That it is that level of EBIT at which my EPS will become 0. And my whenever I calculate financial BP and my EBIT is less than that financial BP, EPS can be negative. If my EBIT is more than the financial BP, then EPS would be positive. Next, the next concept, EPS indifference point. What do you mean by EPS indifference point? Sir, I have two financial plans, plan A, plan B, or plan 1, plan 2. Yes, with debt equity mix, there is a change. So what is indifference point? Indifference point is that level of EBIT at which EPS under two financial plans are exactly the same. So I have two financial plans with different capital structures. So EPS indifference point is that level of EBIT at which my EPS under two plans are exactly the same. Understood? What do you mean by EPS indifference point? It is that level of EBIT at which EPS under two financial plans are exactly the same. So assume this is your indifference point. Sir, which plan will dominate over which plan? Which plan is better than which plan? If your EBIT is less than the indifference point, if your EBIT is less than the indifference point, which financial plan is better? That financial plan with lower risk is better. That financial plan with lower risk is better. In other words, a plan with lower financial risk, lower financial leverage will dominate the plan with higher financial risk. Why? Because your EBIT is less than the indifference point. Suppose if your EBIT is more than the indifference point, sir, which plan is better than which plan? That plan with higher risk is better. That plan with higher risk. Higher risk means what? Higher debt and higher preferential capital. Where there is financial risk, chapter number 2, leverage. Only where there is higher risk. Higher risk arises, financial risk arises because of two reasons, interest and dividend. So if my EBIT is less than the indifference point, plan with lower financial leverage will dominate the plan with higher financial leverage. If my EBIT is more than the EPS indifference point, then that plan with higher financial leverage will dominate a plan with lower financial leverage. Yes. So how do you solve, exam point of view, how do you solve these questions? You need to assume EBIT as X. You need to assume EBIT as X, and whatever is the profitability statement I used to solve, EBIT minus interest minus tax, the same. Rather than solving this way, you solve it this way. Yes, what I have done, I have assumed EBIT as X, then EBIT minus interest into 1 minus tax rate minus preference dividend, exactly your profitability statement. Rather than putting it vertical, I am putting it horizontal, correct? Divided by number of equity shares, that will give you EPS. I am equating the EPS. Now, what is EPS indifference point? It is that level of EBIT at which my EPS under two financial options are same. So I am equating that with plan B. So for plan A, I'll assume, plan B, I'll assume EBIT as X, again X minus interest, EBIT minus interest into 1 minus tax rate minus preference dividend divided by total number of equity shares. I will try to equate those. At what value the equation will solve the value of X, that is called your EPS indifference point. And if my EBIT is less than that, that plan with lower financial leverage is better. If my EBIT is more than that X, more than that EBIT, then the plan with higher financial risk is always better. Again, a very, very important and scoring question. For this you need to understand max is required. Yes. Again, full-fledged capital. These are again the next set of questions are full-fledged capital structure questions will come. Again, when the question is silent, what's the priority? Your priority should be maximizing value per share, because what is the ultimate objective of finance? Maximization of shareholders' wealth. If that is not given, you cannot calculate value per share, then you need to maximize EPS. Sir, I cannot even find EPS from the data given in the question. Then which capital structure theory you will use? Minimum WACC. So full-fledged capital structure questions, what is the priority in which you attempt the questions? First priority is maximization of value per share. Second priority is maximizing EPS. Third priority is minimizing WACC. How do you solve? There will be one or two or three financial plans will be given. You need to start with EBIT. You need to come till EPS. You know this very well how to come. You need to calculate for existing capital structure plus additional capital structure, total capital structure, EBIT minus interest minus everything, cost of preferred dividend, everything. You need to come till EPS. Again, for EPS, existing shares plus new shares, all of this you need to consider. Then P ratio will be given. EPS into P ratio will give you market price per share. That market price per share, wherever it will be maximum, or that you can multiply with the total number of equity shares. Wherever the market value of the firm will be maximum, that financial option you need to choose. Suppose you don't have data to calculate market price per share, you don't have P ratio, then you need to stop where there is maximum EPS. Sir, I don't have income side related data. How do I take a capital structure decision? Then you take using WCC. Wherever there is minimum WCC, you will choose that financial option. Again, these are one more variety of exam questions from this chapter. Coming to last, very important theory questions. There are certain set of theory questions which may appear from this chapter. One is undercapitalization versus overcapitalization. This theory you need to do from module. Again, pecking order theory is important. Then what are the factors that affect capital structure decisions and the trade-off theory. So these are 4 theory questions which you need to do from either from our notes or from ICAI module, so that the entire chapter gets over. Yes. So this was the revision of the entire chapter, capital structure, everything comprehensive, 100% comprehensive revision. What you are supposed to do right now, immediately pick up your question bank, read this, try to make summary notes and solve each and every question, every important question marked as important in the class, and all other questions solve it immediately. Only when you solve questions you can pass FM, because FM is a practical paper. Only theory, only by watching this video you will not pass. Yes. So solve all the questions from your question bank. Again, we'll meet for the next chapter revision lecture. Thank you so much.